Hey, everybody. Welcome back to another episode of Rent Prep for Landlords. This is episode number 306, and I'm your host, Eric Worrell. And today we're going to be talking about the impact of COVID-19 on real estate going into the future. I know that right now it's a lot of things going on, a lot of uncertainty, people wondering what's going to happen with their rental properties or what real estate is going to look like going into the future. And obviously there are more important things going on right now, but this is an episode and a podcast geared towards landlords. So we want to talk about the impacts of real estate. We've got some really great articles from Forbes, an NYU professor, marketplace.org, and propmotto.com that we're going to kind of go into different various niches and different areas and kind of see what we can get from the experts and what they're saying about the impact of COVID-19 on real estate.
1, 2, 3, 4. Yeah.
Welcome to the Rent Prep for Landlords podcast. And now your host, Eric Worrell.
All right, let's get right into it. Our first article is from Forbes.com. The author is Ellen Paris, and the title is The Latest Numbers on Coronavirus Impact on the Residential Real Estate Market. And again, that's from Forbes.com. So what this article here is talking a lot about some research done at Realtor.com. And it said that they just released their numbers for the month of March, which not surprisingly changed significantly over 31 days. So the chief economist at Realtor.com, Danielle Hale, said the month started out to be strong spring buying season, which is what they expected, but the impact of COVID-19 materialized in the later half of March. Week by week, they're seeing decrease in new listings. So this is more so, I'm not talking about rental properties, but actually the sale of properties. And it said it's no surprise that sellers who don't have the hat to sell right now are rethinking listing their homes, and buyers who aren't under pressure to purchase a home are also pulling back. So inventory declines, a key market indicator, are also slowing. So we're seeing buyers hesitating as much as sellers now, where in February, they had a lot of buyers out there actively looking and not enough inventory. So here are what some of the numbers they are finding for the month of March that look like. The numbers of homes for sale declined 15.7% year over year. And despite the decline, the national median listing price grew 3.8% to $320,000. So when Realtor.com looked at the weekly data, including the last 2 weeks of March, as the coronavirus hit more parts of the country, listing prices were growing at the slowest paces for 2020. So here are some more of the data here. In the weeks ending March 21st and March 28th, new listed properties decreased by 13.1% and 34% compared to the year before. So where coronavirus started hitting, COVID-19, March 21st, we saw a decrease in 13.1% in listings of properties compared to the previous year. And then just 1 week later, March 28th, we saw a 34% dip compared to the year prior on the same week. So this supports recent surveys conducted by Realtor.com pointing to declining interest for potential buyers and sellers. So looking at some specific markets around the country and different markets, the biggest declines. So the Phoenix, Mesa, Scottsdale, Arizona market saw a 42% decline in properties listed. Milwaukee saw a 36% decline, and San Diego saw a 33% decline. Now, I don't know what the connection between those three are, because I feel like those are three very different areas. I mean, you could make the claim that San Diego and, Phoenix, Arizona kind of area were, retirement areas, and maybe that's being impacted there, but I can't understand then why Milwaukee would be thrown in there. So there's something specific going on there. But it said that there was only one market that actually saw an increase in inventory, and that was Minneapolis, St. Paul, which was at 3.6% increase. As far as the steepest declines in prices, Dallas-Fort Worth area saw a negative 2.7% decline. Minneapolis, St. Paul, despite their increase in inventory, saw a decrease in pricing at negative 1.4%. And the Houston area saw a negative 1.4% as well. The last thing they said here is that for people who have to buy right now, they're more likely to get a good deal since there are fewer people out there. Conversely, sellers who must sell now know this and must respond to these current market dynamics. So we're going to move to the next article here. This one is from marketplace.org. The title is Pandemic Could Mean Opportunity for Real Estate Investors. I thought there was some interesting insights here. I'm not going to read the whole thing, but Daniel Lebenson, co-founder of the investment firm BH3, said that buying distressed debt built the foundation of his company. So he kind of started his company in Florida, where there was South Florida, there's a lot of distressed properties back in 2008, 2009. And he said that nobody feels good about taking advantage of misfortune, but firms will be looking at this pandemic in the same light. He said now is the time to innovate and go hunting because there will be opportunities. He said phase one is really a repricing opportunity, and I think the acquisition comes a little bit later, maybe 6 months down the road. That's because the real estate market moves slowly, and this pandemic is only a month old in the United States. It's not as if anybody who owns anything is suddenly going to step up and say, oh, sure, a month ago I could have sold this building for $400 a foot, but because I'm afraid what's happened in the market, you could buy $200 per square foot today. That's according to Jim Costello, Senior Vice President at Real Capital Analytics. He said it could get there at some point, just not yet. And the hospitality sector is going to have an especially difficult time weathering this storm. Some of the areas like hotels and travel related, the restaurants, many of those are fairly tight on their cash flow and could actually be facing a situation where they need a buyer fairly soon. And retail office space, one part of the market that many viewed as fairly safe, could be compromised because so many people have learned to work from home. So we're going to be talking about that a little bit more too, but interesting article there from marketplace.org. And I will have all these links in the description of today's show notes. So if you want to kind of read some of these a little bit more, I'm going to pull out a little bit of a section from this article, propmoto.com. It doesn't list an author, actually. Let me go to the bottom. Okay. Franco Fordaro, editor and co-founder. And they got an NYU professor here. So I'll read this paragraph to you because this might be a little bit helpful. The title is Winners and Losers of COVID-19 Real Estate Moratoriums and Forbearance. So he said he asked Tim Savage, clinical assistant professor of real estate at NYU Schack Institute of Real Estate, what he thought would happen to commercial property values if a large number of renters were not able to pay rent for a short period. He said if we think about real estate as an asset class, its value isn't entirely by short-term rent rolls. He said in the short run, we will see perceived values fall, but this is a natural disaster, not a financial crisis. This hasn't affected the capital. It has just affected the human capital. The volatility and pause in transactions that we are seeing is just a reflection of uncertainty. In the absence of data, all we have is uncertainty. So I thought that was pretty interesting. You know, he's just kind of saying that, comparing this to the housing crash of 2008, 2009, he said that this is very different because this is a natural disaster, not a financial crisis. And really right now what we're in is this period of uncertainty. So what they did say is they looked at the perceived value of real estate can often be best understood by looking at public market REITs. So they took a look at those, and this is kind of interesting because like Brookfield Property REIT, if you're not familiar, REIT, it's just, you can actually buy I apologize if my lingo is not correct here, but you can buy a share of a REIT just like you'd buy a stock. So then you'd actually are buying real estate, but you're really just owning like a share just like you would a stock in a company. But instead of it being in a company, it's in a company that owns a bunch of real estate. So Brookfield Property REIT, a giant fund with a large mall and retail portfolio, is not surprisingly down 50% of its market capitalization from the end of January. So Blue Rock Residential Growth REIT is one of the largest multifamily portfolios, is down about the same. But Boston Properties, which owns mostly Class A office space in top-tier cities, is only down around 30%. And the industrial real estate giant Prologis is only down around 20%. So the thought being that the quarantine will strengthen the value of the supply chain companies, and thus industrial warehouses will not suffer the same kind of losses as other sectors. So I'm probably saying it wrong, but Prologis, they are more focused on warehouses and that kind of real estate, where ones that are focused on malls and large multifamily portfolios are the ones that are down the most. And then, like I said, Boston Properties, which owns Class A offices in top tier cities, is only down 30%. So that's kind of interesting, just kind of looking at the different REITs that are out there and which ones are being impacted in different ways, kind of giving you an idea of what might be going on or what you might expect, or at least what the sentiment is across the landscape from different investors. I think that's pretty interesting. So moving to another article here. We got a bunch today. I found a lot of these interesting. I just wanted to kind of share them and move through them quickly. This article is again from Forbes.com, from Ellie Perlman. The title is How an Economic Crisis Can Impact Real Estate Investing. She is the CEO of Blue Lake Capital, LLC, so an investor herself. And she says that the possible impact, number one, now I will preface this, these are all possible, right? Nobody knows for sure what's going to happen, but we can still speculate. Possible impact number one is real estate prices will go down. She says, I believe we will see commercial real estate prices dropping as foreign equity, which is constantly looking to buy real estate in the U.S., will have issues with accessing U.S. markets. The outbreak will affect their ability to invest overseas. Flying to the U.S. from Asia and Europe is becoming more and more problematic, which hurts foreign investors' ability to do business here in the near future. Since many foreign investors look for much lower returns than local investors, they are able to offer higher prices for multifamily properties. With a decline in foreign investments in the U.S. market, the demand to purchase multifamily properties will experience a decline, resulting in lower prices. That's pretty interesting take. Haven't heard that one before. Reading up on things, just saying that, foreign buyers are going to have a hard time purchasing commercial property in the U.S. And I should mention that this article is from April 6th, so it's pretty recent as of publishing this podcast. Possible impact number two is vacancy and bad debt rates might increase. Now, this one you could probably, extrapolate on your own, but basically it's saying that vacancies in multifamily properties might increase, particularly in submarkets where employment is dependent on entertainment. So let's say vacancies in, Las Vegas, right? Las Vegas is definitely a city that you would imagine would be hit pretty hard by this. It's entertainment capital of the world. Last thing people are going to do when their pockets are pinched is go to Vegas and, spend a bunch of money, partying. Well, at least most reasonable people. I say this cautiously, but I believe that there's a good chance that these events will trigger a recession due to the massive disruption in the global supply chain. Since entertainment is considered a luxury, most people tend to cut entertainment expenditures when there is a recession. Unfortunately, if that happens, many employees who work in the entertainment field will lose their jobs. When people lose their jobs, they aren't able to pay their rent, which leads to higher vacancy rates, as some tenants will be forced to move out to a cheaper apartment. It also leads to higher bad debt, as non-payment of rent is considered a bad debt, and many property management companies will work with collection agencies to collect those debts. Also, with layoffs and unemployment, there wouldn't necessarily be qualified new tenants available to replace these or replace those who are evicted for bad debt. In addition, high vacancy rates can wreak havoc with a property's net operating income, and if it's significant enough, it could seriously impact investors' ability to pay the mortgage debt. The domino effect can cause serious problems and extreme situations, foreclosure by the lender if the loan can't be repaid. So basically, that's what that whole possible impact is, a domino effect, right? Especially areas where there's a lot of entertainment, people losing their jobs, people not being able to pay rent, people who own those properties not being able to pay mortgages, and you're just kind of seeing this larger and larger domino falling as the ball gets rolling there. So that's one possible impact. This third one, I don't agree, but we'll read it anyways. Possible impact number three, increased demand from local equity. And I'll get to why I don't agree with what she's saying here, but positive impact could be an internal capital flow towards real estate. Many U.S. investors will do what I did, which is pull their money out of the stock market. Those investors will be looking to put their money into real estate, which historically is more stable than the stock market. I believe that more capital will flow into multifamily real estate from local U.S. investors, which can counter the decline in demand for multifamily and might be able to stabilize prices or prevent a major decline in property values. So what can you do? If you're looking at prospective deals, write very conservatively, account in your analysis for rising vacancies and bad debt. If the deal still works, then it's a good deal. But even if conservative in your income projections, in a recession, you might have to give higher discounts to bring in new tenants. Well, the only thing I was going to say that I disagree with a little bit here is, telling people to pull their money out of the stock market. That's great if you thought of that, the beginning of March. But if somebody's reading this article, this article is posted, like I said, on April 6th, I believe it was. Yeah, April 6th. I wouldn't be writing anything about pulling your money out of the market right now because you're just selling low so that you can move money somewhere else. I don't think that's the best strategy, but I digress. Last article, really enjoy reading this guy's writings. Professor Scott Galloway. I may have mentioned his book before on the podcast. It's called The Four. He also has another one, which is The Algebra of Happiness, which I haven't read yet. But The four was just kind of he talks about like the four big companies that the first one to break $1 trillion valuation: Facebook, Amazon, Google, and Apple, which Amazon was the first to do that. But NYU professor with a background in marketing and economics. And this article is post-corona higher ed. Now, I thought that this was interesting because I feel like there will be some things that landlord investors, especially around higher ed, might be interested in. So one of the bullet points here from his article is that, which was posted on April 3rd, is that things won't change as much as they will accelerate. While other crises reshape the future, COVID-19 is just making the future happen faster. So he says, let's talk about higher education and make some predictions. An industry projected to register $10 trillion globally by 2030 may see the future happen faster. If you read this blog, you're intimately familiar with the below chart highlighting what we academics could not resist the temptation to starch the surplus margin so we can make some more money and be less accountable. So he's kind of got like a funny way of saying things. Basically what the chart is it's U.S. education prices versus inflation from 1998 to 2018. So from 1998 to 2018, all starting at 0%, because we're starting the graph off in 1998, we have seen inflation increase by 54% since 1998. And what is your guess on how much education costs have inflated by? Now, you've probably heard these numbers thrown around before, but it is nearly 3 times as much. So education prices have inflated by 150% since 1998, even though the economy's inflation is only by 54%. And the source for that is the College Board. So he said, yes, you'd likely know there's more student loan than credit card debt. But did you know the price of a textbook has exploded 812% in the last 30 years? It's pretty crazy. So his prediction is that university campuses in New York, Massachusetts, California, Washington, forgive me, I'm not even sure what LA is. Is that Louisiana? I got to look this up. LA state. I can show you guys how little I know. Yes, Louisiana. Are the other states will remain closed for the remainder of 2020. So what he goes on in the article to talk about is the thing that's going to be accelerating is distance learning. And so if you have all these states, especially like, in these California, New York, Massachusetts, with a lot of big universities that are doing all distance learning, it's going to accelerate the adoption of distance learning for people. And what he is claiming is that you will see that the bigger universities with great teachers will start to have larger classrooms because of distance learning and accepting more students, and you're going to start seeing a major disruption in colleges. So this is kind of interesting because if you're thinking about buying property around your local university, or you own a lot of property around your local university, this is definitely something that will affect you. I think just here in Buffalo, right, we have a pretty big campus, about, I think, like 30,000 students at University of Buffalo. And I know that, in different areas, there's a ton of housing there to support those students. Well, what would happen if all of a sudden half of the students are distance learning? So they're in different states, or they're across the state or something like that, and they're no longer actually living here, but they're just taking classes online. The value of those rents, the value of those properties would go down substantially. That has been a great investment up to this point because, you could buy a $60,000 house here 5 years ago, then get pretty good rents for it. But I think that stuff has the potential to change and shift. So that's definitely something you want to keep an eye on if you're an investor in those areas, is if distance learning could impact and disrupt higher education. Because certainly, you've probably heard this before, there may not be an industry that's more primed for disruption than higher education just due to the ridiculous costs. And in the article, he does point out the fact that there's this innate kind of desire for parents to want the best for their kids. And that's why you have continually seen this increase in prices, because parents are willing to step up and help their kids to do what's best, or what they think is best for their kids. But it'll be super interesting to see what happens. So I thought that was a really interesting article. And if you kind of like somebody with a little bit of bite to their writing, it's definitely not if you're easily offended. But Scott Galloway's writing on profgalloway.com is pretty good. I've been enjoying reading his takes on what's been happening in the local economy and national economy. All right, guys, that is it for this week's episode. Wanted to kind of just get into just what's going on in the news and kind of speculation more than anything, right? I don't think any of us really know what's going to happen or what's going on right now, but it'll certainly be a different landscape going forward. But it'll be interesting to see what all falls out. But of course, number one priority is staying safe, staying healthy, making sure you're practicing social distancing and making sure that, you're doing what you can do and controlling your area, your environment. So take care of your family, reach out to people you haven't talked to in a while, and hopefully you're doing well. All right, guys, until next week, have a great week and take care.